You know that feeling, right? Like you're just wading through this endless river of information.
Yeah.
It can feel, well, less like being informed and more like just drowning sometimes.
Yeah, information overload is definitely real.
Exactly. And that's why we're here. Welcome to the deep dive. We take the sources you're interested in, the stuff you've shared, and we try to pull out the really important bits. You know, make it clear, maybe even a bit engaging, give you those aha moments.
Think of us as your guides through the complexity. And today, based on the material you sent over, we're diving headfirst into decentralized finance, DeFi, and the blockchain technology that makes it all possible. It's pretty revolutionary stuff.
And wow, this source material is dense. I mean, it goes from the absolute basics right through to some really complex applications. So our mission, our goal today, is to cut through that jargon, make sense of it all, and give you a solid grasp of what DeFi actually is, what it's trying to do, and, why you might even care.
Sounds like a plan.
I'm actually really excited to get into this one. So let's kick it off. The big one, DeFi. What is it really?
Okay, so at its core, DeFi is basically a movement. It's about building a whole new kind of financial system.
A new system.
Yeah, one that's open source, meaning the code is out there for anyone to see and build on. And it's designed to be accessible to pretty much anyone with an internet connection. Location, financial status, shouldn't matter.
Okay.
And, this is key, it aims to work without the usual middlemen. Banks, brokers, all those traditional gatekeepers. The big picture, the vision, is a more open, more inclusive financial world for everyone.
So taking out the middleman, making finance more direct and open. That's the idea.
That's exactly it. And it's all built on this powerful tech stack. You've got blockchain, cryptography, and these things called smart contracts. It's interesting. People used to call it open finance before DeFi became the popular term.
Right. Blockchain, cryptography, smart contracts. Sounds like the engine driving this whole thing. How do they work together to make it decentralized and open?
Well, cryptography is the security blanket, basically. It keeps everything safe and sound, the data integrity, blockchain, that's the ledger. It's transparent, it's tamper-proof, it records every transaction in a way that's incredibly hard to change later.
Okay.
And then smart contracts are like the automation layer. They're self-running agreements that handle financial stuff automatically. No need for a person in the middle. It's how they all mesh together that's really groundbreaking for finance.
All right, let's zoom in on blockchain for a sec. We hear about it all the time, usually with Bitcoin, right?
Yeah.
What makes it so special?
Well, think of it like a database, but a very specific kind of database.
Yeah.
Your typical database, or like a spreadsheet, organizes data in tables, right?
Sure.
A blockchain stores info in blocks, one after the other. Each block holds some data, and once it's full, it gets linked to the one before it using cryptography. So you end up with this chain of blocks in order that's really hard to mess with.
Like a digital chain of records, where each link is locked to the previous one. A secure history.
That's a great way to put it. And unlike a normal database where one company or person controls it, it's centralized. A blockchain, especially a public one like Bitcoin's, spreads that control out. It's distributed across loads of users on the network.
Oh. Right.
That distribution makes it super resistant to tampering. There's no single point you can attack to take it down or change the history easily.
Right, so the data isn't just in one place, it's copied everywhere. How does that make it more secure, exactly?
It's layered security.
Yeah.
Each block doesn't just hold transaction data. It also has a unique code, a cryptographic hash of its own contents, and the hash code of the block right before it.
That long string of numbers and letters you mentioned.
Exactly, that's the hash. Think of it as a digital fingerprint. If you change even a tiny bit of data in an old block, its hash changes completely.
Oh, okay.
And because each block contains the previous block's hash, changing one block would invalidate the hash in the next block and the next and so on all the way down the chain. The whole network would immediately see something's wrong.
Got it. So to cheat the system, you'd have to recalculate all those fingerprints for all the following blocks.
Precisely. And to successfully rewrite the history, a bad actor would need to control more than 51% of the entire network's computing power. That's the famous 51% attack. Then they'd have to redo all the math, all that computational work for every single block after the one they changed.
51%. That sounds like a ridiculously huge amount of power. Can you give us a sense of how hard that actually is?
Imagine trying to secretly rewrite one page in a history book. Now imagine everyone on Earth has an identical copy of that book.
Okay.
If you change your copy, it instantly looks different from everyone else's. To make your version the official one, you'd have to somehow find and change over half of all the copies out there simultaneously and keep doing it every time a new page gets added. The cost, the coordination. For a big established blockchain like Bitcoin, it's just incredibly difficult, practically impossible.
Ah.
It all comes down to network consensus and the majority agreeing on the state of the ledger. That's how you get trust without a central boss.
That really clears up the security part. Okay, so blockchain is the tech. Bitcoin was the first big use case. But it's not just about digital money, right? What else is it good for?
Oh, absolutely. Bitcoin started as peer-to-peer cash, but the potential of blockchain is way broader. Think about anything that needs a trustworthy, transparent, unchangeable record.
Like what?
Well, people are exploring it for voting systems, trying to make elections more secure and verifiable. Supply chain tracking is a big one.
Yeah.
You've got major companies like Walmart, Pfizer, IBM with their food trust platform. They're using it to track products from origin to shelf.
Food safety, voting.
Yeah.
That's a wide range.
Yeah,
Any other big areas?
definitely. Traditional finance, banking, blockchain can speed up transactions, cut costs, automate things with smart contracts. Some reports estimate savings in the billions.
Billions. Wow.
Yeah. Healthcare secure medical records, giving patients control. Property records, tamper-proof ownership, especially useful where government records might be unreliable. And supply chains, like we said, proving where things came from, making sure they're genuine and safe.
It really sounds like a foundational tech. So what are the main pros and cons we should keep in mind?
Okay, pros. Better accuracy because you reduce manual steps and intermediaries. Lower costs for the same reason. Decentralization means better uptime, less risk of single points of failure. Transactions are secure, transparent on the public ledger, and really importantly, it offers banking options for people in countries with, say, unstable economies or restrictive financial systems.
Makes sense. And the downsides, what are the catches?
There are definitely challenges. Energy consumption is a big one, especially for blockchains like Bitcoin that use proof-of-work mining.
Right, the environmental impact.
Exactly. Transaction speed can also be an issue. Some blockchains are much slower than, say, the Visa network. There's the historical association with illicit activities, though regulations are catching up fast. And finally, the regulation landscape is still patchy. It's not consistent globally, which creates uncertainty.
Okay, blockchain foundation laid. Now, these smart contracts you mentioned, the name sounds, well, smart, autonomous. What are they?
Yeah, think of them as computer programs that live on the blockchain. Ethereum is the big platform for this. A smart contract is basically just code and some data sitting at a specific address on the blockchain.
Code on the blockchain.
Right, and the smart part is that they run automatically. When certain conditions are met, conditions written into the code, the contract executes specific actions all by itself. No human needed to press a button. Users interact with them by sending transactions to their address.
Self-operating agreements. Huh. Could you give me, like, an analogy?
The classic one is a vending machine, a digital vending machine. You put in the right input, the correct amount of crypto. If the conditions are met, you paid enough, the items in stock, boom, the machine automatically gives you the output, your snack, or whatever. Smart contracts work on that same if this then that logic. If the conditions in the code are met, the result is guaranteed and automatic.
And people write these contracts using special programming languages.
Yep. On Ethereum, the main ones are Solidity and Viper. They're specifically designed for writing these kinds of blockchain-based agreements.
Gotcha. So how does one actually execute? What makes it run?
It's all automated. Once the contract code is deployed on the blockchain, it just sits there, waiting. When someone sends a transaction to the contract's address, and that transaction meets the program conditions.
Like putting the coins in the vending machine.
Exactly. Then the contract automatically carries out the actions defined in its code. And that action and any resulting changes get recorded permanently on the blockchain. Now, because running this code uses network resources, users usually have to pay a small transaction fee. On Ethereum, that's called gas.
Gas. Like fuel for the contract.
Pretty much. It pays for the computation. And this isn't just theory. Smart contracts are being used right now. Think automated payments money released only when delivery is confirmed, for example. Or enforcing financial rules transparently. Or cutting out middlemen in processes like procurement payment happens automatically when goods are received.
That does sound way more efficient. Takes out the trust element, or at least puts the trust in the code.
Yeah.
You mentioned a rental example earlier from Vitalik Buterin.
Yeah, Vitalik's example is great. Imagine you pay your rent using crypto into a smart contract. The contract holds your payment and the digital key to the apartment.
Okay,
If the landlord doesn't provide that digital key to the contract by the agreed date, the contract automatically sends your crypto back to you, refunded.
nice.
But if the key is provided on time, the contract waits until your move-in date, then automatically releases the key to you and the rent payment to the landlord. All automatic, based on the pre-agreed rules in the code.
That's powerful. Trust baked right in. What other kinds of things could these be used for?
Oh, tons of possibilities. Governments could use them for more secure, transparent voting, maybe boost turnout if it's easier. Businesses could streamline workflows, automate approvals.
Hmm.
The auto industry may be determining fault in an accident automatically based on sensor data, or adjusting insurance rates based on how you drive. Real estate, like the rental example, cutting costs. Healthcare, managing patient records securely, automating insurance claims. The potential is really broad.
So the benefits seem clear. Autonomy, trust, security, speed, savings. Seems like a big upgrade.
Definitely. You get backup from the blockchain being distributed, safety from the cryptography, speed from automation, savings by cutting out intermediaries, accuracy because it's code, not fallible humans interpreting rules.
But, I mean, it's still code, right? Code can have bugs. What are the downsides or the risks with smart contracts?
You're absolutely right to ask. That's a major risk, bugs or security holes in the smart contract code itself. And the tricky part is once a contract is on the blockchain, it's usually immutable. You can't easily change it.
So a bug could be permanent.
Potentially, yes, and could lead to people losing money irreversibly. Then there are regulatory hurdles. How do you tax these things? How do existing laws apply? It's still being figured out.
Okay.
And there's the link to the real world. What happens if that apartment in the rental contract gets condemned? The smart contract might still try to execute based on its code because it doesn't automatically know about the real world event. Most blockchains limit contracts from directly pulling in outside information, like from a website.
So can't just check the news or a government website to see if the building's okay.
Not directly, no. It usually relies on data fed onto the blockchain. Getting that external off-chain data reliably into the blockchain is a whole area of development itself. That's where things called oracles come in. And while Ethereum is the leader here, other blockchains have varying, often more limited smart contract features. Bitcoins are very basic, for instance.
Okay, so it sounds like Ethereum really is ground zero for a lot of this DeFi stuff. Why Ethereum? What makes it the main hub?
It really comes down to its smart contract platform. It's powerful, it's flexible, it gives developers the tools they need to build all sorts of complex decentralized apps, or DApps as they're called.
Right, the apps.
Plus, Ethereum just has the biggest community of developers working on this stuff. It creates this strong network effect, you know? More developers mean more tools, more apps, which attracts more users, which attracts even more developers. It feeds itself.
A real ecosystem effect. Like Silicon Valley for DeFi.
Kind of, yeah. And because of that, you see this incredible variety of DeFi apps built on Ethereum. We're talking decentralized lending and borrowing, stablecoins like we mentioned, decentralized exchanges for trading, derivatives platforms, DAOs, those decentralized governing bodies, prediction markets, savings accounts, staking.
Whoa, okay, slow down. Let's unpack some of those. Lending and borrowing, that seems fundamental. How does that work without a bank?
Right, so you have platforms like MakerDAO. They're famous for creating DAI, which is a stablecoin pegged to the US dollar.
The stable ones, okay.
Yeah. So you can lock up other cryptos like Ether as collateral in MakerDAO, and then you can borrow DAI against it. But you usually have to over-collateralize.
Meaning you put in more value than you borrow.
Exactly. Like maybe deposit $150 worth of Ether to borrow $100 of DAI. It protects the system. And it has automatic processes for paying back loans or selling your collateral if its value drops too low. MakerDAO also has a governance token, MKR, that lets holders vote on changes to the system.
Okay, MakerDAO and DAI. What about Compound? Hear that name a lot too.
Compound's another big one. It's a decentralized money market. You can supply cryptos like DAI, Ether, USDC, and earn interest. Or you can use your supplied assets as collateral to borrow other cryptos.
And the interest rates.
They're dynamic. An algorithm adjusts them automatically based on how much supply and demand there is for each specific crypto on the platform. Compound also has its own token, COMP, which they give out to users who lend or borrow. It gives them voting rights, too. And when you use Compound, you get these things called SIC tokens. They represent your balance and earn interest automatically.
So it is kind of like a decentralized savings and loan account.
That's a good way to think about it. And then there's Avar, another major player. Similar lending and borrowing, algorithmic rates, but they also have some unique features like flash loans, loans you take out and repay in the same transaction block without collateral. Pretty advanced stuff.
Flash loans.
Yeah.
Sounds wild. Okay, and stablecoins again.
Okay,
You
yeah.
said they're pegged to things like the dollar. Why are they so important in DeFi?
Because crypto prices can be incredibly volatile, right? Bitcoin, Ether,
Yeah.
they can swing wildly. Stablecoins aim to minimize that volatility by tying their value to something stable, usually the US dollar, but sometimes gold or even other cryptos.
How do they keep the value stable?
Different ways. Some are backed by actual assets, like USDC or Tether claim to hold $1 in a bank account for every token they issue. That's fiat-backed. Others might be backed by commodities, like gold. Then you have crypto-backed stablecoins, like DAI, which use other cryptocurrencies as collateral, usually heavily over-collateralized. And some try to maintain the peg using algorithms and clever economic incentives without direct backing.
So they provide a stable unit of account within DeFi, making it easier to actually use for financial transactions.
Exactly. They bridge the gap. You can use DeFi without worrying quite so much about your base currency losing half its value overnight.
Makes sense. Okay, next up, decentralized exchanges, or DXs. How do you trade crypto without a central company like Coinbase holding everything?
DSs let users trade directly with each other peer-to-peer. Your crypto stays in your wallet until the trade actually happens. They often use smart contracts to handle the swap automatically.
So more secure in a way.
Yeah.
No central honeypot for hackers.
That's a major advantage, yeah. Reduces counterparty risk. DXs can also offer more privacy, often without needing strict KYC. Know your customer checks. But there are trade-offs. Sometimes they have less liquidity, meaning fewer buyers and sellers, which can affect prices. And there are technical challenges like front-running.
Front-running?
Yeah, where someone sees your trade coming on the blockchain and quickly places their own order ahead of yours to profit from the price change your trade will cause. It's a known issue.
What are some popular DXs?
Big ones include Uniswap, Curve, Balancer. They often use a model called an automated market maker, or AMM. Instead of matching buy and sell orders directly, they use these liquidity pools.
Liquidity pools, right. You mentioned those for yield farming. How do they work for trading?
Okay, so an AMM liquidity pool typically holds two different tokens, say Ether and DAI, locked in a smart contract. The price is determined by the ratio of those two tokens in the pool. When you want to trade, you swap one token for the other directly with the pool.
And the liquidity comes from
users. People called liquidity providers, or LPs, deposit pairs of tokens into the pool. In return, they earn a share of the trading fees generated by that pool. It incentivizes people to provide the funds that make trading possible.
Got it. So LPs provide the assets, traders swap against those assets, and LPs earn fees. What about more complex stuff like derivatives, futures, options?
That's happening in DeFi too. You have platforms like Synthetics where you can create and trade synthetic assets. These are tokens designed to track the price of anything, stocks, commodities, other cryptos, so you can get exposure without actually owning the underlying asset. Futures, options, swaps, they're all being built out in decentralized ways.
And margin trading, borrowing to trade bigger.
Yep, that's available too, often powered by those decentralized lending protocols like Compound or UPU we talked about. You borrow funds against your collateral to leverage your trades, higher potential returns, but also much higher risk, of course.
Of course. With all this complexity and risk, what about insurance in DeFi?
It's definitely emerging. Given the risks of smart contract bugs, platforms like Nexus Mutual are trying to create decentralized insurance. Members pool funds together to offer coverage against specific smart contract failures or exploits on certain platforms.
That seems pretty necessary. And you mentioned oracles before, getting real-world data onto the blockchain.
Yeah, oracles are crucial. Smart contracts often need reliable real-world information like the current price of oil or the outcome of an election to execute correctly. Oracles are services that securely feed that off-chain data onto the blockchain. Chainlink is probably the best-known example of a decentralized oracle network.
This ecosystem is huge.
Yeah.
You also threw out things like identity, gaming. How do they connect?
It really is sprawling. Identity solutions are trying to tackle financial inclusion. How can you access DeFi if you don't have traditional ID? Gaming is integrating DeFi concepts too, creating play-to-earn models where in-game assets have real value and can be traded on DeFi platforms. Pool Together is a fun example. It's like a no-loss lottery built on DeFi savings protocols.
Lost lottery.
Yeah, everyone pools their money, it earns interest via DeFi, and then one lucky person wins all the interest earned, but everyone gets their original deposit back.
Huh, clever. And you mentioned money Legos.
Right, composability. That's one of DeFi's superpowers. Because these protocols are open and built on the same blockchain, like Ethereum, they can easily plug into each other. Developers can combine different DeFi Legos, a lending protocol, a DX, a stablecoin to create entirely new financial products relatively easily. It fuels innovation like crazy.
Money Legos. I
Yeah.
like that. And DAOs keep popping up. Decentralized Autonomous Organizations. Remind me what they do.
DAOs are basically how many of these DeFi projects govern themselves. Instead of a CEO making decisions, the holders of the project's governance token, like MKR for Maker DAO, or compound vote on proposals, things like changing fees, upgrading the protocol, allocating funds. It's community-led governance, all run through code and voting on the blockchain.
Okay. And with all this growth, how are things like regulation and compliance being handled? KYC and all that.
It's a major focus and a moving target. Traditional finance relies heavily on KYC identifying the customer. In DeFi, that can be tricky because of the pseudonymous nature of blockchain addresses. So there's a growing emphasis on KYT, know your transaction.
Know your transaction.
Yeah, analyzing the transaction patterns and risk profiles associated with specific blockchain addresses rather than just focusing on the individual's identity. Tools are being built to help with this. Alongside that, you have user-friendly wallets like MetaMask or Argent, making it easier to interact with DeFi. You see marketplaces emerging for peer-to-peer exchange. Payments are still fundamental. Prediction markets like Augur let you bet on outcomes. Savings accounts earn interest. Staking lets you earn rewards for securing networks like the newer version of Ethereum. Tokenization lets you create digital versions of real-world assets. And trading covers everything from simple swaps on DXs to complex derivatives. It's a whole parallel system.
A parallel system. How does it stack up against CeFi centralized finance, the traditional world?
Key differences. DeFi is usually permissionless. Anyone can use it, often without asking permission or giving up lots of personal data. CeFi is permission you need approval, KYC. DeFi is mostly open source. CeFi is proprietary. DeFi runs on decentralized infrastructure, CeFi on centralized servers. DeFi can have lower costs, mainly network fees, and is harder to censor. CeFi involves more intermediaries, often higher fees, and is subject to censorship.
And what about open banking? Sounds similar.
Similar goals, maybe, but different approaches. Open banking uses APIs to let regulated third parties access your traditional bank account data with your permission, of course. It's about innovation within the existing banking system.
Okay.
DeFi is trying to build a whole new system outside of that. So open banking might let you see all your different bank accounts in one app. DeFi lets you interact with entirely new financial tools that don't rely on banks at all.
Got it. So why all the hype around DeFi lately? It feels like it exploded.
Several things came together. Innovation was moving faster than regulation for a while, allowing rapid growth. Big traditional players started noticing and getting involved, adding legitimacy. Then you had global factors like very low interest rates after COVID-19.
Making DeFi yields look attractive.
Exactly. If your bank account pays almost zero, earning, say, 5% or 10% lending stablecoins on BB, compound looks pretty good, right? Even with the risks. That brought in a lot of capital. And then there's just FOMO, fear of missing out. People see huge growth, hear stories, and want in. We're also seeing regulators start to engage more formally, like the SEC approving an Ethereum-based fund, but regulation still poses big challenges for some projects.
Okay, so boiling it down, what are the core benefits, the big advantages of DeFi, and what are the biggest risks we absolutely need to keep in mind?
Benefits. Programmability, create new tools. Immutability, secure, auditable records, interoperability, the money Legos thing, innovation, transparency, see what's happening on chain. Permissionless access open to more people, self-custody, you control your keys, your assets.
So lower costs, less reliance on middlemen, more access, more control.
That's the promise, yes. Removing intermediaries, cutting fees, no single points of failure, banking the unbanked, rules enforced by code. It's a powerful vision.
But the risks. It sounds great, but it's new territory.
Absolutely crucial to understand the risks. Smart contract bugs, code vulnerabilities can lead to total loss of funds. That's huge. Need for good audits, maybe insurance like Nexus Mutual. Assessing how decentralized a project really is, some aren't as decentralized as they claim. Systemic risk, if a major asset crashes or one big protocol fails, it could cascade through the interconnected system.
Like financial contagion, but with code.
Kind of, yeah. Network congestion, high demand can make transaction fees skyrocket, especially on Ethereum sometimes. User error, it can be complex. Sending funds to the wrong address is irreversible. Bad user experience, it's still not as smooth as traditional banking apps for most people. And just the general chaos of a rapidly evolving ecosystem, it's hard to keep up and fully grasp all the risks.
Okay, Risks noted. Very important. Let's switch gears slightly to yield farming. Sounds agricultural, but for crypto. What's the deal there?
Yeah, the name's catchy. Yield farming is basically putting your crypto assets to work within DeFi protocols to earn more crypto. It's about actively participating, usually by lending your assets or providing liquidity to get rewards back. Passive income, essentially.
So making your crypto generate more crypto, like earning interest, but potentially more complex and higher yield.
That's the idea, and it answers that question, don't you need a bank's worth of money to play? In DeFi, the capital, the liquidity for lending and trading, comes from thousands of individual users pooling their assets together online, HO dealers putting their crypto to work.
Right, and that brings us back to liquidity pools.
Yeah.
How do they fit into yield farming?
They're often the engine of yield farming, like we discussed with DEEZs. Users called liquidity providers, LPs, deposit pairs of tokens into a smart contract pool. By doing that, they enable trading on platforms like Uniswap and AMM.
And they get rewarded for providing that service.
Exactly. They earn a cut of the trading fees from swaps happening in their pool. Plus, many protocols offer additional rewards, often in the form of the protocol's own governance token, to incentivize people to provide liquidity. That's a core part of yield farming, chasing those extra token rewards on top of trading fees.
So I put my Ether and DAI into a Uniswap pool. I earn fees when people trade between them, and maybe I even get some UNI tokens as an extra reward.
Precisely. The pool needs liquidity to function smoothly. Deep liquidity means less price impact when someone makes a big trade. The fees and extra token rewards are the incentive for LPs to provide that capital. Uniswap takes a small fee per trade, distributes it to LPs.
It sounds like you could get pretty creative, moving funds between different pools and protocols to maximize those rewards.
Oh, absolutely. The most successful yield farmers often have complex strategies. They're constantly monitoring different protocols, moving assets around to capture the highest yields, maybe borrowing in one place to lend in another. It can get very intricate.
How do people even track all this? Is there a way to measure the size of this yield farming space?
Yeah, a key metric everyone watches is TVL, total value locked.
What do you call it, though?
Total value locked. It measures the total dollar value of all the assets currently deposited or locked in DeFi protocols, either across the whole ecosystem or in a specific platform. It's seen as a rough gauge of the health and growth of DeFi. Sites like DeFi Pulse track this stuff.
Okay, TVL. So yield farming mostly happens with these AMMs, liquidity pools. LPs provide funds, earn fees and tokens. How do they estimate profits?
You'll often see yields quoted as APR, annual percentage rate, or APY, annual percentage yield. APY includes the effect of compounding returns, and this is but these are just estimates.
Well, just estimates.
Because the DeFi market moves so fast, rewards change, token prices fluctuate wildly, new strategies pop up, those annual figures can be misleading. Experienced farmers often focus more on short-term, like weekly or even daily return estimates because things change so quickly.
Got it. High potential, but also high volatility and uncertainty. You mentioned collateral again earlier with lending. Is that a factor in yield farming too?
Definitely, especially if your strategy involves borrowing. To borrow assets on platforms like a Hub or Compound, maybe to leverage your farming position, you need to put up collateral. And it almost always over-collateralized.
More value locked up than borrowed.
Right, and if the value of your collateral drops too much or the value of what you borrowed goes up, you risk liquidation. The protocol automatically sells your collateral to cover the debt. That's a major risk in leveraged yield farming.
Liquidation sounds painful. So yield farming isn't just free money then. What are the main dangers?
No, definitely not free money. The complexity is one danger. It's easy to make mistakes. It often favors whales, people with lots of capital who can absorb fees and risks better. Smart contract risk is always there. A bug in the protocol you're using could drain the pool. And then there's that composability risk. Again, the money Lego risk. Your strategy might rely on 3 different protocols working together. If one of them breaks or gets exploited, your whole position could unravel. You're trusting the entire chain.
So you need to understand all the interconnected pieces. What are some of the go-to platforms for yield farmers?
Many we've mentioned. Compound, where you earn CMP. MakerDAO for minting DAI. Synthetics for creating synthetic assets to farm with. A for lending, borrowing, staking. Uniswap and Curve Finance are huge for providing liquidity and earning fees, plus their own tokens, UNI, CRV. Balancer is another liquidity protocol with its own token, BAL. And then you have aggregators like Yearn Finance.
Aggregators.
Yeah, Yearn Finance tries to automate the process. It automatically shifts user funds between different lending protocols to find the best yields, saving users the effort of doing it manually. Kind of like a robo-advisor for yield farming.
Interesting. Okay, we've really covered DeFi and yield farming. The source material also briefly mentioned Bitcoin mining. Is that still a thing regular people can do?
Our source touches on it, yeah. It's another way to get crypto, besides buying or earning through DeFi. The analogy is digital gold mining.
Right. How does it work? Simply.
Miners basically validate transactions happening on the network. They bundle them into blocks, and then they compete to solve a complex mathematical puzzle. The winner gets to add their block to the blockchain and earns a reward.
What's the reward?
Right now, it's 6.25 Bitcoin per block. It halved recently. But the catch is, the competition is insane. So much computing power is dedicated to Bitcoin mining now that trying to do it alone, solo mining, is pretty much pointless for an individual. The odds of finding a block are tiny.
So firing up some software on my gaming PC isn't going to make me rich.
Haha, almost certainly not, no. The specialized hardware needed now is way beyond consumer-grade stuff. That's why the source recommends joining a mining pool.
A pool, like a lottery pool.
Kind of. Lots of miners combine their computing power. They all work together to find blocks. When the pool finds a block, the reward is shared among all the members based on how much power each person contributed. It smooths out the earnings smaller, more frequent payouts instead of a near zero chance of a huge one.
Okay, that makes more sense.
Yeah.
If someone did want to try pool mining, what's involved?
First, you need a Bitcoin wallet to receive any earnings. You can get software wallets or use online ones. But remember, the blockchain itself is huge if you download the whole thing. You'll get a unique Bitcoin address.
Like from Coinbase, the source mentioned.
Yeah, exchanges can provide addresses. Then, research and choose a mining pool. Look at their fees, how they pay out, how big they are. Make sure you enter your wallet address correctly when you sign up.
Crucial step.
Absolutely. Then, the hardware. Forget CPUs or even most GPUs for Bitcoin now.
Yeah.
You need an ASIC.
ASIC.
Application-specific integrated circuit. Hardware designed to do one thing really, really well. Bitcoin mining calculations. They're expensive and use a lot of power. And finally, manage expectations. Check profitability calculators online. Factor in your hardware cost, your electricity cost. The difficulty keeps going up, so it's a tough game.
So mining's still happening, but it's mostly big specialized operations now, not hobbyists in their basements.
Pretty much, yeah. It's industrialized.
Wow. Okay, we have covered a ton of ground today. From the basics of blockchain and DeFi all the way to yield farming and mining. Let's try to wrap this up. What's the core takeaway for our listener?
I think the key is that DeFi is really about these decentralized applications, apps running on blockchains. They use smart contracts to let people conduct financial activities directly with each other peer-to-peer. The big goal is cutting out those traditional banks and brokers. Uniswap, the decentralized exchange, is a perfect example. It just runs on code, connecting buyers and sellers without a central company in charge.
So it's fundamentally trying to build a financial system that's more open, more transparent, maybe more accessible to everyone.
That's absolutely the driving vision. Using blockchain's transparency and security and smart contracts automation, DeFi really does have the potential to create a different kind of global financial system. More efficient, maybe fairer, definitely more open.
It's been fascinating digging into this. It's clearly a space moving at lightning speed, full of incredible potential, but also, as we discussed, some pretty significant risks and complexities.
Yeah.
It really leaves you thinking, what's next? What kind of completely unexpected things might people build with these DeFi money Legos? Could we see applications that totally blur the lines between today's finance and this decentralized future, maybe changing how we think about value itself in ways we can't even imagine yet, especially as digital worlds become more integrated with our lives? Definitely something to keep watching and exploring.